This is Josh from Holland Knight out of Nashville, and we may have just been able to get him to agree to join us at the summit and do a 5-minute Ignite talk on, ultimately, the ethical side of these MSO deals. Can you give us a quick primer, as if I was British, a quick primer on the ethical side of these deals?
I can. Nice to be with you guys today. The key rule that we have to operate under is Rule 5.4. This has two components that we need to be mindful of. The first is the prohibition on non-lawyer ownership or control of law firms. And the second is the prohibition on splitting of fees between attorneys and non-attorneys. So when you structure a transaction involving an MSO, which is where a private equity fund comes in, right? They form an MSO, it's going to acquire the non-legal assets of the target, which we mean kind of almost everything, except for those handful of assets that need to remain owned by the law firm, which is attorney workforce, client engagement letters, client funds, files, records, trust accounts, and the like. Everything else gets owned by the MSO, which can be sold to an investor. Right? It enters into a long-term management services agreement with the law firm at the closing. And you have a two-company structure where the investors can control the MSO, the law firm remains owned by the lawyers, and there needs to be a clean line of delineation between the two. So you should not see the investors telling the lawyers what cases they can or cannot accept, how to litigate or handle a particular matter, hiring or firing of attorney workforce. All of those are exercises of legal judgment that need to be handled on the law firm side, whereas the investors can handle the non-legal aspects of the business, right? Non-attorney workforce, facilities, marketing, HR, finance, IT, right? All of that is the portfolio of the MSO to take off of the law firm's plate. Thesis being that if the law firms are able to focus more completely on the practice of law, energized and more capitalized with the resources of the fund and the MSO behind them, that they can take the firm to the next level.
And talk to us a little bit about your role in some of these deals. Like, where do you sit in all of this?
Yeah, so I co-lead Holland Knight's legal services transactions team. I am a corporate and M&A lawyer by background, and I co-lead the team with my colleague, Trish Rich, who is a legal ethicist. We work together very closely to structure and execute on these deals. And so I represent either buyers or sellers in these transactions. So we are involved in all aspects of the deal, from negotiating the letter of intent to helping to design the tax structure of the transaction, to negotiating the definitive agreements, to everything else that's involved. And we're working with the legal ethics team in tandem to make sure that at the end of the day, the transaction documents comply with applicable rules of professional conduct.
Okay, so you see both sides of these transactions.
We do.
What makes for a great transaction? Like it's going to be positive for everyone involved. We're setting this up the right way. What does that look like?
Yeah, it's going to start with honesty and alignment between buyers and sellers from day one, right? Of when they meet each other and start those discussions, even prior to the letter of intent. The seller has got to know why they want to do a deal, right? What is their motivation? And they've got to be candid with the buyer about that. If the seller really is looking to retire in the near term, that can be fine. But in that case, they need to be honest with the buyer, and they need to be able to demonstrate to the buyer that there is a succession plan in place to transfer the business to the next generation of leadership and ownership. Right? There's risk associated with that, and if the systems are dependent on that founder, right, then the buyer is going to be taking on. So you need to have good alignment. From the seller should also be asking the buyer about their approach to these transactions generally, right? Get comfort that they're not going to come in and violate Rule 5.4 by telling the lawyers how to practice, right? Ask those questions, have those conversations on the front end to align expectations and make sure that there's a good cultural and personality fit, as well as a business plan fit between both sides of the deal.
And these are they're hard for me, and I think hard for a lot of our listeners, where we get into like the ethics things. Everybody's very apprehensive about this. Some things are obvious for practice of law. I think you named a couple of those things, and let's face it, like the money people and the MSOs, like they don't want to get into the practice of law. They don't want anything to do with it. However, there's some stuff where it does seem a little bit murkier, right? And we both own marketing agencies. Like we get that, like you can outsource marketing, you can outsource HR, intake and that kind of stuff. But there's some things where you're like, you think about the prospective client calling the firm. they call the firm, they talk about their, I imagine intake sits in the MSO.
Does.
They're starting to have conversations, and I imagine the MSO, with the guidance of the law firm, is like, these are the types of potential clients, qualified clients that we're looking for. But isn't the decision even to take the case on, doesn't that kind of overlap with practice of law, or how do you separate that?
Oh, it does, yeah. And so there is a rule of professional conduct 5.3, which is one that doesn't get very much play out there, but it's actually fundamental to the structure. I learned early on when working on these deals that every legal ethicist has a favorite rule of professional conduct. Trish's is 1.6, and I have adopted 5.3 as mine. So what it says is that a law firm is permitted to outsource non-legal business services to third parties, provided that they're not fee sharing, and provided that the third-party service provider is acting under the direction and the purview of the lawyer and its law firms, and the ethical duties of the lawyers are imputed to that third-party service provider, right? So payment's got to be, fair market value for services rendered, cannot be a fee split, and it's got to be kind of ethically compliant, in its structure. That is the foundation for the MSO model, right? Like that is the model. So when you think about something like intake, well, those intake personnel, they are working, under the auspices of and at the direction under the purview of the lawyers in the law firm. So for sure, I would not want to see the MSO, making unilateral decisions about which clients to accept or not accept. Rather, it's their duty to kind of pass on the leads, and the lawyers will determine whether it makes sense to engage.
Got it. And this is I want to take to the second part of your favorite rule, which is the fee sharing. So, and again, this is new-ish for us. Most of the outsourced services that we see, some of them are hourly, some of them might be flat fee retainer, but none of them are tied to profitability of the law firm. They're not pegged to case results in any way. Talk to us about how these deals are structured, from how the money flows from the law firm to the MSO.
Yeah, this is one of the most important questions. It's generally the first question I get when I hop on the line with investors who are looking at this investment thesis. The answer is that the economics are going to flow through this management services agreement, which is entered into at the closing and connects the MSO with the law firm. It provides that the MSO is going to, provide this laundry list of administrative services to the law firm in exchange for payment of a monthly service fee. Again, like the MSO might also own the intellectual property and the branding, even up to and including the name, image, and likeness rights associated with the founders, and then license those IP assets back to the law firm by operation of these management agreements. But however structured, you really have two choices when it comes to the fee that is going to be paid by the law firm. You can do a fixed monthly fee, or you can do a cost plus fee, right? What you cannot do, what violates law, is a fee that is a percentage of law firm profits or revenues. That is going to directly violate 5.4. So,
sorry, percentages of law firm revenue or profits?
Correct.
Okay.
Yep. So those are off limits. Instead, you're looking at a fixed monthly fee or a cost plus fee. And we add a further gloss on this, which there's a Texas ethics opinion from last year that gets into this in some detail. The overall fees, the aggregate fees, however structured, payable by the law firm, need to be commensurate with fair market value.
Got it.
Okay.
Someone mentioned
I was exactly my next question.
Yes. And this is not a new concept to us. Okay. My background is as a healthcare M&A lawyer. So I've been doing professional services M&A for 12 plus years. Law I've been doing for a little over 3 years now, but certainly my deeper roots are in healthcare. There are plenty of jurisdictions that ban physicians from splitting fees with non-physicians. And they interpret the rule in exactly the same way that I just relayed to you, right? No fees based on a percentage of profits or revenues, has to be fixed monthly fee or cost plus, and has to be fair market value. So, that obviously has not stopped billions upon billions of dollars of capital being deployed in healthcare services down the years, including in all of those jurisdictions where that rule exists via these MSO structures. So the way that we got comfortable with this structure in healthcare is by engaging a valuation firm to actually conduct what we call a transfer pricing analysis, right? This is transfer pricing is kind of a method, a discipline that's developed down the years. It actually has its origins in tax law, right? Imagine you've got a corporation in a high tax jurisdiction. You want to figure out a way to transfer revenue to a low tax jurisdiction. The classic way to do that is have low tax corp enter into a management agreement with high tax corp. Okay, but the IRS would view this very skeptically if the fee that was charged to extract the value was not fair market value, right? Because that's just pure tax avoidance.
Right.
So therefore, this whole discipline has developed around valuation firms looking at these kind of services agreements, working through a valuation exercise and looking at market comps and saying, this is what is fair. The IRS can challenge that, has done many times, and so there's all kinds of tax court cases that tell us what this looks like. We have used for probably 30 years that same type of methodology in healthcare to extract revenue from a professional entity via a management agreement. And we've been working with valuation firms, again, for many years in that space. We have imported this doctrine into the legal services investment space. So about 12 months ago, when this market really started to heat up in a way that was there was a noticeable sea change. One of the first things that I did was hop on the line with a number of valuation firms, PwC, BDO, Stout, very, very well-respected white-collar professional services groups, and talk to them and say, okay, like we've worked with you for these kind of valuation exercises, transfer pricing exercises in healthcare. Could you do law? And those groups kind of conferred internally, up to and meeting with the highest echelons within their organizations, and came back to us and said, yes, we can. And so that is how we ultimately get comfortable, right? We engage the firm, they do a detailed study, they dig into the guts of the financials of the target, and then when we design the services agreement, we kind of layer up the fees to kind of get to the best possible place that we can. You start with the value of the administrative services that are provided. You can get a markup on that, right? That's equal to fair market value for services rendered. Then there's the layer of the intellectual property, right? The branding, the website, the logos, the trademarks, right? All of that, a little bit more amorphous, a little bit more difficult to price on that, but there's kind of standard approaches that these firms have used to price intellectual property for, again, many, many decades. You can look at other levers as well. Things like technology is a very important kind of potential lever here. About 14 of our clients in this space are AI native law firms. These are firms that we have structured as MSOs to take in early venture financing money. Think like Y Combinator and early stage investors like that. And then they use the money to develop proprietary software products. And we start with the tech company, and then we actually establish a de novo law firm as like an appendage of that, using an MSO structure connected via a software license agreement as well as your typical set of MSO documents. And that the fact that that software is so embedded in the workflows of that law firm, and it is used to dramatically enhance the efficiency of services rendered so that that firm can offer fixed or alternative fee pricing and get the spread, right? Like that's extremely powerful economic lever. You can attribute a huge amount of value to that kind of proprietary software. So that is those are some of the main ones, but there's others that you'd look to as well.
And so clarify that for me, because also, by the way, really well outlined for us. I think you've navigated this, I think, better than anybody I've heard. So thank you for joining us. So I'm using AI software, like one of these law practice AI softwares. Is that license living in the MSO, or is it living in the law firm?
We'll generally want to put as many of the assets into the MSO as possible. The theory being that the more value and the more assets we can concentrate at the MSO, the more we can substantiate a higher service fee to extract as much value as possible. So the general rule of thumb is if it can be in the MSO, we generally want it to be there. We acknowledge that, take a software license agreement for like Harvey or something like that. It might be difficult to interface with a third-party vendor to get that assigned over or have the right to then sub-license that software to the law firm itself. So we're practical about it. But yeah, as a general matter, you'd like to see anything that can be over there, would be over there.
And and maybe I'm getting this wrong because naive about this stuff, but if the software, some of that software seems very close to law practice, right? Like it's some of it's writing demand letters, some of it's doing that kind of stuff. But you're able to navigate that because it's still got the lawyers got ultimate say over how that software is being used.
Exactly right. Yeah, the view of the ethics bar on this is that AI cannot practice law. It's not a person, right? And only people can practice law. But yes, any work product that's actually kind of being delivered to a client, you would want to make very sure that it is reviewed and approved by a lawyer.
Right, and that would be true of any kind of pleading or anything, even without AI. That would still be
Correct.
the case, right?
Yep.
Very interesting. I think the other thing. Do you have any other questions?
No, I was going to shift a little, maybe given your experience. We've asked a couple of people this question. Oh, sorry.
You're good.
Oh, no, we're good.
Yeah.
Growth through acquisition, like outside of the whole MSO conversation, which we've been really focused on here, but law firms thinking about growth through acquisition. Mm-hmm. What's a great opportunity for that, and where is it like the red flags, this is something you should stay away from?
So, the buy and build model is what is being pursued by private equity in this market at the moment, right? Like the playbook is first, private equity wants to identify some sort of what we call a platform, right? So something with a little bit of size and scale and heft to it.
Yep.
And then, that's the first transaction. Once that platform is in place, they now have the operations, the systems, the people to begin kind of making add-on acquisitions. And for those types of targets, you'll want to ideally have a firm that has done its kind of pre-sale prep work. This can be quite important to enhancing the likelihood of a successful transaction. Getting your own financial house in order is probably the single most important thing that a founder can do in order to facilitate a successful deal. That means actually spending time and money on advisors on their side pre-closing to evaluate their last, call it 3 years of financial statements, make sure that they can prove out and substantiate the information and the data contained in those financials. Some sort of pre-transaction legal diligence can also be advisable. Like have your counsel come in there and just look under the hood, if you will, make sure that from an ethics standpoint, right, are your engagement letters properly drafted? Are there any disclosures that you should have been making but haven't been to your clients? Or what is the understanding if there are issues, right? There's some malpractice case that's been asserted against the firm, or there's other risk factors out there. At least identifying what those are and getting out ahead of that can be helpful. There might also be instances where you think you're complying with the law and you're just not, like any business in the U.S., right? And so the better you can identify any potential deficiencies and mitigate those pre-sale process, the better the likelihood that you'll have either an increased valuation because you have a clean business, or at the very least, more successful outcome for your transaction.
Okay.
And then I'm really interested in kind of the nuts and bolts and the weeds of this stuff. So is there an operating agreement at the MSO or?
Yes, okay. There will be. So when these deals are structured, one unique aspect of this industry that's driven by our rules is that lawyers generally cannot be bound by non-competes, even in the context of a sale of a business, which is quite unique. And scary, frankly, for private equity investors. It's one reason why you saw healthcare and accounting and other professional services verticals, engineering, experience private equity investment long before legal services. It's because it's just more difficult to get comfortable and structure a deal in this sector. So one way that to mitigate that lack of non-compete risk from the fund's perspective is to ensure that the sellers take some of their purchase price in the form of what we call rollover equity. This is basically continued skin in the game. Just by way of example, let's say you've got a target law firm. It's got an enterprise value of $1 million. Maybe 70% of that would be paid in cash at closing, and the remaining 30% would be paid in equity in the buyer entity itself, right? So this is just like, if the buyer were Apple Corp, it would be paying you in shares of Apple stock.
Yep.
And you'd have to put a price on that, and so you get $300,000 worth of buyer MSO stock. You as a seller would should expect to be bound by the terms and conditions of the governing documents of the MSO. It's going to have its own governance, right? Probably a board. It will have typically repurchase triggers tied to your equity. So if you engage in misconduct, then they might be able to yank back your equity. It might have other restrictive covenants, not a non-compete, but other types of restrictive covenants that you at least want to be aware of. So it's important from the seller's perspective to do what's called reverse diligence and actually request information about the buyer entity, right? Because you want to know, like, I would like to see, buyer, your financial statements so I can understand, are you appropriately pricing your stock that I'm receiving as part of my purchase price?
Right.
Or send me copies of your governing documents so I can understand from a legal standpoint what I'm going to be asked to sign up for.
And I imagine this varies from deal to deal, but
Yes.
in your sense, do a lot of the lawyers end up taking on board positions at the MSO, or do they kind of stay out of the MSO from a more leadership standpoint?
It will depend on transaction size and the kind of role, the go-forward role that's envisioned for the founder there. So this would be an example of an important conversation that seller and buyer should have as they are getting into the transaction process, like at the LOI stage. Seller should be asking, what is my continued role in the business? Or if a buyer has identified a lawyer who says, that person's a leader, I want them to be involved at the highest echelons of our organization to help us look at the strategic map of the U.S. and help us figure out how to build this thing together, because I value their perspective based on their experience. And that kind of alignment is very important. And then for a small add-on deal, once the platform is established, then I probably wouldn't have those expectations for a seller in that situation. It could be, sure, but it'd be unusual.
Right. And then the other question I'm so interested about is the managed services agreement between the firm and the MSO.
Yep.
What kind of, and obviously negotiating varies all over the map, but what kind of length of terms do you have? Because I imagine the MSO wants to lock in the law firm to this deal for a long period of time.
Yeah, functionally speaking, so it's often going to be 20, 25 years. I had a client ask me if we could do 100 years. We actually looked at some Delaware law. We were not able to find an outer bound, but I said at a certain point the court's probably going to say that's not enforceable. But functionally speaking, once a law firm enters into that management agreement, it's probably never going to get out of it, right? Because think about at the time, the platform changes hands and private equity fund number one sells to private equity fund number two. Well, private equity fund number two is going to look at all of the MSO documents and say, okay, we're 6 years into a 20-year term. As a condition to closing, I would like to refresh this, please. Right. So I've got a fresh 20-year clock. Yeah. And that is how it has happened in healthcare, and it is what will happen here. And
the incentives are largely aligned, right? The law firm people, they want to stick with the MSO because they're shareholders in the MSO.
The whole thesis of this model is around creation of equity value in the MSO. This is a concept that is foreign to a lot of lawyers because law firm equity is not real equity in very meaningful ways, right? Every year, law firms are liquidating almost in their entirety. They're making distributions of all available profits to the shareholders based on their performance in the past year or two. That is an inefficient way to run a business, right? If you want to actually grow a business, then you need to be reinvesting, right? And then with a view towards selling the business, like that over time. Again, it's not my job. It's the burden of the private equity funds to have these conversations with lawyers, show them the spreadsheet math, right? If you were to continue taking your distributions for the rest of your career, it looks like this. Right. If you were to join us and then have some MSO equity and have a successful exit, it looks like that. That's a hearts and minds campaign, that's right? But yeah, I think that it's from an empirical standpoint, that's going to create a better outcome. Yeah. And so there should be alignment there.
How much of that value is created for early players in that deal, just through the nature of the increased scale?
Yeah.
Right. My early equity is worth a lot more.
It should be
compared to the 30th firm that we've acquired. So how much of that for the early players is it tied up in that value creation versus we're now running a much more efficient organization, and it's not there's efficiencies of that scale, but it is not necessarily based on when I participated.
Yeah. So these transactions are typically priced as a multiple of EBITDA.
Yeah.
Like that's how you see transactions priced on just the normal M&A markets, and that's what you see here too. EBITDA for the listeners is really, just think about it as like the earnings of your firm.
Usually what they're taking home.
Exactly. Yeah. In law firm
Those
space,
are two different things, people.
in the law firm space in particular, EBITDA is usually very, very close to actual like net income as reported on the tax return. And so for a smaller firm, you might see it trade at 2 or 3 times EBITDA, thereabouts. Sure. For a more substantial platform, the current market is somewhere around 5 to 8x EBITDA. And the entire goal here is to kind of grow and expand. And as the business grows and expands and adds EBITDA, it becomes more valuable, not just from like a total amount of EBITDA standpoint, but actually the multiple attached to that.
Increases.
This is called multiple arbitrage,
right.
And it should tick up over time, hopefully. So the idea here would be, if you are an early mover and you transact with an MSO at a time when the MSO is pricing itself at 8 times earnings, and then several years later it sells at a 12 times, right? Then that's represents a substantial appreciation in the value of your equity investment.
Right. And that was my question. In your experience, like, and I get that it varies a lot, but how long is that several years typically? And do the PE firm, do the funds talk about that at the beginning? Like, are they talking about like, hey, we're planning to do this over the next X years?
Yes. In fact, a lot of these funds are raised for fixed life cycles of 5 to 7 years.
Is that
and
typical,
so
5 to 7?
Yes. And so they are actively looking to try to transact on that time horizon to execute their business plan, deploy the capital, and deliver a return to their investors. That is one reason why you see a lot of private equity funds, when they're working on a deal, they're sprinting and they're trying to get it done because they are under their own set of time constraints, right? There's this time value of money aspect where the faster they can get the capital deployed and get a return to their investors, the better the overall performance of their portfolio. So yeah, 5-ish year, 3 to 5 years would be a fairly typical expected hold period. Could be longer.
And what are the consequences? I mean, I don't even know how they're trying to get to a certain EBITDA number and then make that transaction. And what are the consequences if they don't hit that?
Yeah, that's exactly what they're trying to do. They're usually targeting a certain what's called a multiple of invested capital return to their investors, like kind of cash on cash. Type return of like 3x or 4x would be a fairly typical target that the private equities investors set, right? So pitch to their investors upstream is, we're going to try and return you 3 times your money within the next 5 or 7 years. Okay, and so when they grow to a sufficient size and scale, they will constantly be evaluating and reevaluating, right? Is now the right time to sell? What are the prevailing market conditions? Have we grown and scaled sufficiently? Have we integrated the company sufficiently so it's going to present well to the market? When you have like a fund-to-fund transaction like that, you really want to have professionalized the business at that point. It's to get that really premium, multiple appreciation. You're going to have to show you're not just a collection of misfit toys or assembled parts, but rather like you've done the hard work to create a cohesive, unified company from a technology standpoint, a system standpoint, an administrative standpoint, reporting structure, right? Like all of that will make it a much more kind of turnkey, professionalized asset that is right. The next buyer, because keep in mind, if the next buyer comes in at that 12x, well, now they've got to exit at like a 15 to deliver that type of return. So they're going to want comfort that they're really stepping into like a sterling platform that they can use to like go out and grow and grow and grow, right?
Right.
Right. They're doing their own buy and build, right? They buy in at 12x, but now they're making acquisitions at 3, 4, 5x, and they're working to grow organically. And the theory is, well, if we do our jobs right, then we can get that successful, exit at the end of the day. But
any questions?
You got it.
This was amazing.
Yeah, thank you so much.
I don't even know if you want people to reach out to you, but if people wanted to learn more about this, where would you direct them?
Yeah, you can find me on LinkedIn, Josh Porte, Holland Knight. I'm also, you can look me up on Google on our website, and my email address is there.
Josh, Thank you so much. That was amazing.
Thanks so much, guys.